Welcome back to the exchange. Small caps are on a tear, rallying about 10% in the past month and outpacing the Dow, the Nasdaq, the S&P. But my next guest says they are no longer cheap, and the next leg will require strong earnings. Joining me now is Jill Carey-Hall, head of U.S. small and mid-cap strategy at Bank of America Securities. You're like a celebrity this month, Jill. Lots of questions, I can imagine. Welcome.
Thanks for having me.
So what do you say to the tourists who are suddenly, all over the small cap space? What would you tell them?
Look, I mean, I think there have been a lot of positive drivers for small caps. And, when we had gotten more cautious on the Russell back in the spring, when we had continued to see, higher than expected CPI data, a lot of investors were kind of looking to the Fed as one sort of necessary catalyst for the Russell to continue to move higher. So now that's what we're seeing. We've seen some sustainably lower than expected inflation prints, more confidence that the Fed will begin to cut. And we saw that in performance when you look within the Russell over the last week or two. You've seen highly leveraged stocks as some of the best performers. Obviously, a lot of refinancing risk within small caps. We've seen a general risk on. We've seen some short covering. And the technicals are positive, and we've started to see some inflows. So I think there's a lot that's still supportive. But I think what, as you mentioned, what a lot of investors are now focusing on is earnings. And, we've seen a profits recovery start to take hold within the overall U.S. But usually when small cap profits get hit harder, they bounce back faster. We haven't seen that this time. And, since the start of the year, estimates have just been cut lower and lower for small cap profits.
If people are curious about the valuations, you have some good data on this. Right now, the Russell 2000 is trading about 15.5 times forward earnings, which is more or less its historical average. The only place it's really cheap still is next to large caps. And so you might argue, well, do large caps have to mean revert lower? Is it possible that small caps mean revert higher? But you're not looking for a lot more multiple expansion here.
Right. I mean, when you've looked at the recent rally, it's been all multiple expansion since earnings have actually gotten revised down further. Small caps are no longer cheap on an absolute basis. They're still the least expensive size segment of the three, but they're certainly starting to price in more good news. As you mentioned, they are still very cheap versus large caps, a little bit less so when you take out the Magnificent Seven, but still trading at a discount. So I think, valuation tends to matter the most over the long term. So if you have a 10-year time horizon, that tends to be a highly explanatory factor on return. So I still do see small caps as offering better return potential in investors' portfolios over the next decade than large caps, especially after the decade of underperformance that we've seen. And I think there are some positive medium-term themes. A capex recovery in the U.S., reshoring. These are positive to domestic mid caps. But I think near term, if we want to really see the rally continue, I think investors are going to be focused on whether this very back-end loaded profits recovery can actually come to fruition and really focus on guidance and this earnings season, because so far the trends within small caps have still been much weaker than large this earnings season.
Yeah, and my final question would really be about that. And I should mention you're also interested in European small caps and kind of some more value areas if you wanted to get really specific. But on this profit and earnings question overall, what are your expectations for the next 12 months? And is the most important now the kind of fourth quarter of this year?
Yeah, I mean, I think, initially at the start of the year, when you look at what analysts were expecting, they were expecting by this earnings season, small cap profits would have already recovered positive and would have been outpacing large cap profits growth. But small cap profits growth is still very negative this quarter. When you look at the S&P 600 consensus, it's, down year over year for across the board for most sectors. Guidance is still below consensus. So I think and when you look at the proportion of beats, we've seen a pretty healthy proportion of EPS beats, but most companies are still not surprising to the upside on sales. So I think if we can see a beat and raise quarter, if we can see commentary get a little bit more positive within small caps, that could give investors some confidence that the big back-end loaded profits recovery isn't just an unrealistic hope. And so I think it's a good time to still be selective. There's still, a lot of opportunities within small caps, as you mentioned, within, value stocks, but ones that have positive rather than negative revisions, profitable companies. And even amid the recent risk rally, you still saw stocks with positive estimate revisions up there as, among the top performers. So I still think there is that focus on the fundamentals.
Some words of wisdom and a good reminder as we get carried away with the mania. Jill, thanks so much for your time today. Appreciate it.
Thanks.
Jill Carey-Hall with Bank of America.